People have been crushed, every 7 or 8 years by these bubbles that have been perpetuated by not only Wall Street and their research analysts, but the media that supports it. That's why we call it Old Wall and its media. I mean, it's all one big cabal. They all get paid to ignore or not even understand. I'd say that's probably the bigger problem at this point. They just don't get it. It's not that they're bad people. It's just that they're ignorant. They've never worked in a real hedge fund environment. They've never built one. They've never built a company like we have. And that's a travesty, is that the country is being led by sheep. So don't be a sheep. Again, get yourself in a position where you can find the right access points, the right data, and make good decisions from a risk management perspective. Can you show the CFTC futures and options data? There it is. So this is something that you'll never see, obviously, on TV, because I don't even know if they could explain it. But again, it's futures and options data. We're looking at non-commercial net long positioning. That's the reason why we do that, is because that's a good way to track the consensus that is the hedge fund community. When you get over or over 2 rather on a 1-year Z-score, so again, think in terms of standard deviations of the position itself relative to itself, you could see that the Russell 2000 right now is the most extended net long position in all of macro. Big macro, I'm talking about, not all of macro, obviously, whereas the British pound on that 1-year Z-score is the most negatively positioned. So in other words, the Russell was most likely to go down a lot last week, and the pound was most likely to go up. It's a very short-term risk management signal, but it was right, like it usually is, again, last week. Everyone's long everything. I don't know if you could see that. Like, there's net long position. There's net long positions in S&P, in U.S. stocks, in 10-year bonds, in crude and gold. Not copper, obviously. It's been a certified train wreck. But people are long everything on the very basic premise and short the dollar. You can see the relative to itself, its positioning is negative. They're bearish on the dollar, they're bearish on rates, and they think that the Fed's going to save them. I mean, that's exactly what people think. I mean, so there's going to be a point here where I think rates go down and stocks go down, bonds go up and gold go up. And that's what we saw, really. We're the only firm to make that call coming out of the December rate hike. If you get a hike, I think that's the easiest call to make, so we're going to stay with that. Relative to positioning, that's a very good place to be. Admittedly, a lot of people are long bonds now after a big move. But we got a great cost basis in bonds. I mean, I'm not selling bonds. You think I'm nuts? Yeah, some people probably say, yeah, Keith, you are nuts.